Okay, so comparatively to the past week and stuff, I've been touching on the global affairs as well as the financial literacy on how to begin and everything. So today itself, I'll be touching more on the portfolio management before I go into company evaluation next week. Yeah, so for those who are joining for the first time, thanks for coming in. I've actually decided to start this project by myself to do a little bit sharing regarding my passion and stuff lah. I'm not a consultant yet, so if let's say you want to take further action, also do the required research or seek your own financial advisor, for consultation and stuff. So portfolio management itself is actually to meeting the specific investment goals, benefiting the respective individual investors out there. So today itself, I'm going to touch on what we are looking out for as well as what to look for in a sense. So a little bit of update comparatively to last week itself is that the unemployment claims has jumped from 6.6 million all the way to 70 million at this point of time. Even more coming in, but the numbers are not out yet. Death caused by COVID has actually risen to over 100,000 already, unfortunately, and based on last Friday statistics and news. 1.6 million life has been affected at this point of time. More towards the finance economy sector would be pounds actually appreciated comparatively to the based on US dollar because as we know that US is printing more and more money, which cause devaluation within their own currency. Business actually starting to resume in some part of China lah. I mean, we can see this from the stats that's given out by the banks in China itself. Lending has started to increase. Consumer has started to start spending more on luxury goods and stuff like that. So China, in a sense, they are slowly picking up in terms of their economy and stuff. So back to portfolio management. I'm going to touch on a few things of what we need to know. First thing I think is what we're going to cover today is your goals lah. So what I'm going to share with you is in my own opinion and from what I have learned as well. So try not to take it as like a guide, as in like a very fixated way on approaching your own style. So what I want to do is, let you know what are the various methods or various instrument or strategies that's out there and try to cater or utilize them to cater to your own needs. Yeah. So this guy, but instead use it as like a, like I mentioned, like a leverage, to enhance in terms of decision making and stuff. So moving on to your investment goal, I think to start things off, you have to identify what's your goals, what's your needs and everything. Start by penning down, and doing the homework. No point talking about it because, action speaks louder than words, like in a sense. Plan out and write down what you have researched on. Whatever research, at least have a first draft, second draft, third draft, doesn't matter. Found that to go and see whether the draft that you have, the research that you have did, is it plausible? Does it back up your goal in a sense? So after you have done all these, bring up to your friends, talk to them, and after that, see if let's say it makes sense or not. I mean, if you need any help, I mean, you can ask your own financial advisor, or I mean, you can ask me if I'm free. So on top of which, it's also important to set expectation. Unlike school where lessons come first, in this lesson comes before the test, but in this case, tests come before the lessons. So to make sure we don't fail hopelessly out there, do the necessary required work, to not get smacked in the face that hard lah. Life isn't that pleasant. So goals itself, what you have to ask yourself is, will you prefer to manage the portfolio more actively or passively? Like the reason why I asked that and why you should ask yourself is because I'm sure you have other work commitments. Most of y'all here are students. Some of y'all are already working. So some of y'all might have families as well, have kids to take care of. So you have to know what are the time allocation that you have. Everyone only got 24 hours, but how you utilize it is another question. So understanding that you will be, exposing yourself to various risks that's out there. So you need both emotional as well as financial ability in order to face them head on. So ask yourself the kind of portfolio that, they can cater to these both needs. Actively, passively, your time that you have, the risk that you're going to face. So do you want an income, a growth, or a savings portfolio out there? So as for the portfolio, generally, you will want to, keep a mix of between stocks, bonds, and mutual funds itself. I will touch on that in a bit. So the reason why you want to diversify is so that, you can minimize the risk that you are taking given the current economic, I would say situation. So I'm not saying that you should buy a handful of each instrument as, you would therefore required to, spend a lot of time in terms of understanding individual instrument. So what I can say is, start small, start with one company also. Slowly, then from there you learn, you pick up. Then as you get more comfortable, more I would say well educated regarding the respective field, then you start to expand your horizon. So I will share more about the respective instrument that I have touched on during the first session, and hopefully allows you to fully maximize or utilize them. So moving on, we'll start with stocks first. I mean, this is the most common thing and everyone is talking about. So stocks in a sense could be renamed as shares or equities. So I have actually categorized them into 4 different chips, 4 most common chips lah. There's more than just these 4. So blue chip, green chip, red, and purple. So blue chip itself is actually a more reliable company. As for green, is within the green industry. Red chip is more for representation for the Chinese or the Hong Kong company itself. As for purple, it's just the combination between blue and red. So maybe a reliable Chinese company, a reputable Chinese company. So among these stocks, there are various types. Understanding them actually helps us in terms of identifying what we want to build towards the portfolio that we have set out. Okay, so for the first one will be the income, which is tend to be reliant on dividend. Companies that they pay out regular dividend, well established with proven track records. Cyclical are normally companies that closely follow the economy trend. So companies like the hospitality industry, like hotels, like the tourism and everything, because or the consumer index, for example, like your clothing lines. So if let's say the market's not doing well, people don't spend as much, companies like this will get affected. So if let's say the economy is booming, people want to go and travel, companies like that will be doing well as well. So that's what I mean by cyclical stocks. Defensive stocks, they provide consistent dividend and with stable earning. Even during downtime, they still drop in terms of in terms of market value, but in a sense, they are companies that tend to do well regardless of what's going on around. So companies like Koufu used to be like BreadTalk, but now BreadTalk was privatized. So companies that like Sheng Siong. So regardless of what's going on around the world, people still have to eat. People still need to purchase food, decent kind of clothing like or utility or essentials. So these are considered defensive stocks. Growth stock itself is companies that can generate revenue and cash flow faster than the industry average. So comparatively to their peers out there, they are able to outperform them regardless and like consecutively for various period of time. And hopefully we want to look at long term lah. But there's only so much that a company can grow. For example, a $1 million company, a $1 million value dollar company can grow 100%, 200% to 2 million, 3 million, 4 million. But a $500 million company can only grow so little percentage. They cannot grow another 500 million in such a short period of time. So that's also another food for thought, another consideration as well. Tech company are just mainly in the tech industry like Apple, Google, and stuff like that. Speculative stocks, they are welcome and loved by traders, not by people like me, because I'm a fundamental. Due to the high volatility and I'll try not to touch on that. But if you want to ask, I can explain more at the end. Those that are highlighted in blues are, I would say, something that you guys can look into if you are starting out your journey. They are more easy to understand and better to grasp as a whole. Okay, moving on to bonds. Similar to stocks, they have their own fair share of varieties out there. So essentially, bonds are debts that issued from the respective firms or institutions. Bonds have their own credit rating, so it's like AAA or all the way to C's and D's. So I think in Singapore MAS, a decent bond would be, I think, at least AAA. I mean, you want to look for bonds that are like that, or at least triple Bs. Like you don't want to B grade bond. You don't want to look at C and Ds because they are considered junk or high yield. Means the chance of the firm or the institution defaulting means declaring bankrupt is very, very high. So going into them, junk yield bonds, like I mentioned earlier, convertible bonds are hybrid securities. Call options together with equities. This is slightly more, I would say, more chima, more. You need to do more homework on them because it's like upon maturity you can decide whether you want to take it, you want to cash out or you want to convert them into company shares. So that's what I mean by a hybrid security between call options and equities. So I think the one example you can see now on the news is SIA. because they are in needs of funds. And what Temasek Holdings has done is actually to not only pump in money, but to issue out what we call the convertible bonds for the shareholders itself. And I'll cover more on that probably next week. Zero coupon bond doesn't pay out any interest lah. Like they doesn't pay out dividends and stuff. They pay one lump sum upon maturity. So yeah, so like mentioned previously, the one that highlighted blue is what you want to look into if you want to start your journey and stuff. Funds itself is actually a basket of stocks or bonds that put together into like a hamper thing and is sold to the investors. So generally speaking, for people who wish, to own a bundle of like company within that same sector, for example, I want to hold finance company. So I'll try to find a fund that hold DBS, OCBC, Hong Leong, UOB, Citibank, Standard Chart, all these company within that fund. And I don't have to buy individual company by itself. I can just pay this fund manager, and then together with the rest of other individual investor, we pool together some money to buy that fund, to put the money into it, in a sense, in layman term. So yeah, it's generally for people who wish to, to own a bundle of various companies, but is unable to buy them individually lah. So the pros is well diversified, away from various risks that the individual company is facing. Cons is the management fee. Some management, if it's a large fund, normally the management fee will be low, but if it's a small fund, it tends to be pretty high lah. It's ranging from 0.5% all the way up to maybe 2-something%. So similarly, some funds are managed more passively. They are reviewed on a quarterly or semi-annually basis, while some are more actively managed. They are reviewed monthly to quarterly basis lah. Lastly will be hedge fund. Hedge fund itself is actually private investment and the only available to accredited investors. So it's pretty high risk lah. Means like if you don't have 100K, we don't have to look into hedge funds lah. If you want to understand more about index fund and exchange traded fund, they are kind of similar. But then exchange traded fund is mainly managed by the respective fund managers lah. Index fund itself is more towards tracking towards the economy itself. So like for Straits Times Index is the reflection of Singapore economy, Singapore market. So index funds is like, they just track STI lah, to put it simply. So now we have understand what's going on. I mean, like what's the various instrument that's out there, the three most basic to look for. How can we, gather all these instruments, then maybe develop a portfolio that can, suits our needs lah. Okay, so for the portfolio type, like I mentioned earlier, there's the most basic three kinds, which is growth, income, and savings. Growth company, so it's more active to passive as we go down the list lah. So growth is you have to manage it more actively lah. You mean you've got more time as a student, or maybe your job allow you to have more time, to manage it. Then growth is definitely what you want to look for. So growth portfolio by itself is actually consists of instruments that are like growth potential. For example, in the stocks case, will be growth stocks, speculative, and tech stocks. So these are the companies that are that have the potential to do way better than their peers within respective industry, or within the industry itself. Tech itself in 21st century is a growing business, so they tend to do better than the rest. Like for example, comparative to old school like media such as like Singapore Press Holding, for like a newspaper MediaCorp, all this, that this company will do way better than the old school company. Income portfolio itself is consists of stocks like the income, cyclical, as well as growth lah. A bit of growth, you need a bit of that lah. So you want a company that can produce dividends as well as have a proven track record of their own stability lah. So you know that they won't get affected by external like the unsystematic risk lah. Like for example, if let's say let's say if inflation were to increase, or let's say a new tax law were to come in and like tax were to increase and stuff like that, how will they be affected? So you want companies that is strong enough to withstand all this. Savings itself tend to be more low risk, low return kind of thing. But so it's mainly focusing on income stocks and defensive stocks like blue chip company that they are too big to fail kind of thing. Strategies out there will be dollar cost averaging, value averaging, and lump sum. So dollar cost averaging is mainly for investor that want to put in, unsure of what's going on within the economy or unsure whether this company is of fair value. So there's a lot of uncertainty and inexperience in a sense. So what you want to do is to avoid the volatility, you put in every single month at a fixed time with a fixed amount. So for example, I put in $600 within the STI index fund, more consistently on a monthly basis with the same amount, regardless of the price. So that's called dollar cost averaging. So for value averaging, right, is to identify the intrinsic value of a company. It means whether the company is trading at fair value. Is it worth to put in the money at this point of time, or is the company a premium company? It means the company is so at overpriced, or is the company undervalued? So that's the thing you got to ask yourself. And this, for value averaging, you tend to need to do a little bit more homework because you have to gain certainty to understand what a company is, and what a company is doing and what's their potential future. So you have to forecast a little. You're not speculating, but you're trying to understand. So for example, if you know that for real estate investment trust, right, you know, if let's say they have already set up a lease agreement with their tenants, so you know that the tenants is not going to run away because of the clause within the lease agreement. So you know that for the next 5 years, they're going to do decently well. And especially if their tenant is a reputable company. So for example, for example, I'm opening an office and I rent out to a tenant, and let's say the tenant happen to be Singtel. You know, Singtel is not going to run away because they have the monetary capability to pay for the rent. At the same time, they're going to stay there for a long period of time. So that's something you can look into. Lump sum investing is just basically just all in. But then it tends to be mainly for people that have actually already done enough homework, and you know, have their overall understanding of the business itself. That's why they decided, okay, you know what, this company deserves my money. I don't have to, you know, average my money in. I can just like put all my money in them, then just put it there for 10, 20 years. Then okay, then watch it grow kind of thing. So these are three different kind of strategy you can look into. I mean, I'm sure there's more. There's like factor investing, intrinsic value, and like a ratio and stuff like that. But then these are the three you can start on first lah. Portfolio risk itself, this is just a general guide as to how you can approach, not how you should approach. On the other hand, of course, everyone has their, you know, different needs and stuff like that. So you just adjust them accordingly lah. If let's say you really hate mutual fund or hate funds, right, you just want bonds and stock, it's totally fine. If you don't like stock at all, you can just hold bonds and mutual funds. That's perfectly fine as well. Because you need to know, investing into the respective instrument itself actually requires homework in a sense, and that's what I always do. Because for myself, I'm an investor that relies on fundamental analysis lah. Yeah. So moving on towards the to talk about risk for yourself under value investing. The conventional approach is high risk, high return. That's the case, but not most of the time. So what? I mean, you have to ask yourself whether it makes sense to you lah. I mean, this makes sense to me, so I'm just sharing my own opinion. So if you think it doesn't make sense, just say it doesn't make sense. Then we can discuss on that. We can debate on that. So what Graham's view? Graham's is Warren Buffett mentor, Benjamin Graham. So Graham's view is, in terms of returns, the more homework that you do, the higher the return is. And for risk is the more homework you do, you are trying to reduce the risk. So the conventional way, like I mentioned earlier, is risk to return, which is what everyone is thinking. But to me, is I think if you just do the more homework you do, the higher return, and you lower your own risk in a sense. I think this has to do with something that the story that I shared with you, I think last 2 weeks back, regarding the taxi, the driving thing. So there are two types of risks out there: systematic and unsystematic. If you are a driver out there, you got the license, you got the experience, you are reducing your unsystematic risk. But systematic risk is like external factor, like a drunk driver out there that you know that has the potential to cause hazard lah. So yeah. So what to look out for in a sense is we have to understand the global situation before we start investing. Like for example, now COVID, what kind of company you want to look into? You tend to want to look into healthcare, you want to look into Sheng Siong, you want to look into Koufu. People need to eat, people need to buy, people need to shit, so they need toilet paper. You want to look for your financial advisor to get insurance. You want to still got what? You want to invest in like Dettol, Clorox, yeah, companies like that. So consider how your portfolio will do again. So you also have to understand at this point of time, there will be dividends cuts by various companies, even though they are displaying 11%, 12%, 15%. There will be dividend cuts definitely. Defaulting of smaller enterprise, like smaller company that cannot sustain through this because they have to pay up the debts, unstable balance sheet. So trading have many considerations facing more than the how do I put it? So you have to understand who you are trading against as well. So as an investment like hedge fund and stuff like that, so for funds itself, you want to look into this specific sector, the specific industry. That's why we talked about it last week. Okay, so the next one is investment versus speculation. So why I'm not against, but I won't go for speculation is because when you're trading, there's many considerations. You are facing off more experienced traders that's out there. The fees that is incurred to you is pretty high lah. So and 80% of trades actually lose money lah, statistically speaking lah. And the third point will be understanding a little bit deeper about the financial market. With this understanding, I think it can help you in terms of your portfolio planning lah. So financial market is, by itself is actually the oil and the grease of the capital market. There's a difference between financial and capital market lah. So they are actually the oil and grease for the capital market. So capital formation actually is actually directing the capital, which is your money cash flow, to its higher and the best user out there. Companies with the best innovator, highest productivity, with potential future economic growth. So in a sense, companies that are actually doing well companies that is doing well and will do well tends to last long term. So these are the companies you want to look out for and put in your portfolio. I think lastly is actually to understand the magic of compounding lah. Getting 7.2% actually doubles your money every 10 years. That's just math. So yes, sir. Start now. With that, I actually come to the end. I'll do some sharing, some simple sharing as to how to begin and everything. So I know everyone got their $600 today, right? So I will touch a little bit on how you can use your $600 to potentially grow that $600. Yeah, so let's start. Okay, so those that have $600 itself, right? You all probably are using OCBC, right? I mean, you all heard OCBC. I don't know other banks, but yeah, OCBC is good. So what you look for is OCBC blue chip investment. The good thing about this is you can put in $100 every single month, then they'll just invest to you into the top 30 blue chip company in Singapore, which is good. See why we love this? Because you can access to blue chip shares, Singapore listed traded funds for only $100. So you can do it 6, and I'm sure you got more than $600. So do something about their money. Okay, so moving on, I think I'll just share with you guys the books that actually that could potentially help you lah. You can find this author, Glenn Arnott. He write a lot of books. Most of them are hard to get. I cannot get my hands on it. That's why I go to the library and borrow them. Go to the library and read them. You cannot borrow them. You cannot take out of the library. I don't know why. The second book, I think is the most common, would be this, Value Investing, by this guy. From Grams and Buffett lah. Then the third book we want to look into is Intelligent Investor, which is this red color book that everyone has been talking about. Okay. So, I'll share a bit more about my portfolio if let's say you guys buy gold. Okay, I'll answer the question in a bit. So, okay. Don't follow what I do. Do your own homework, because everyone has been doing well since 2016 all the way to 2019. So my portfolio will definitely look good. As you can see, I actually lost money because of the virus. So 1.5K. What you want to really look for is to have the portfolio. Sorry. So what you are trying to achieve is you want to achieve a portfolio whereby you can do well in the long run. So don't look at this portion. We look at the earlier portion. So the orange color represent STI. The red color represent my portfolio. So what you want is you want a portfolio that can do better in a sense comparative to the market. In a sense that you can use this as a benchmark. So if your portfolio is doing above the benchmark, you know that you are doing pretty decent lah. And for my portfolio itself, it generate about 5 to 6% returns every single year. So we can start from there. And I'm trying to build a portfolio that is higher and higher. So yeah. Okay. And I left with 10 minutes. Sorry. Yeah, today is a bit long and stuff. Okay, I'll click back into this. Okay, so far, does anyone have any questions? Right, Tianmu, what the hell is that supposed to be? Okay, any questions so far? Because if not, we can call it a day. And if y'all have any more stuff, y'all can just message me privately. You want to see portfolio? I will show you this lah. I was trying if Poems can churn a chart out like yours. I don't think so. I have been using Poems also. I got 2 brokerage accounts. I'm not sure if Poems can do that though. I don't think so. Yeah, I don't think so. This is a separate platform.
What if I want to invest into?
Sorry?
Like overseas ETFs in the States, for example.
You can
like
do that.
Vanguard.
You can do that, but that's also you have to understand how the overseas market works. Some market itself, like for example the States, they tax on your earnings, on your dividends. So they're into your dividends in a sense. Singapore, they doesn't do it because we are the financial hub. So for example, if I'm getting 5% return from this company, right, I'm getting the full 5% if I'm investing in Singapore. But if I invest in overseas, if I get 5%, they might eat my 1%. So what I'm getting is 4%. And the conversion rate back to Singapore, there might be a conversion fee for your broker, and maybe you're only getting 3% out of that 5% back. So this is something I have to look into as well. Singapore don't tax dividend. Yeah, Singapore, our government don't tax on our dividend, our capital gains. That's why it's good to invest money, because if you don't invest now, there's inflation that's considered. Singapore is not that high, it's on average about 1%. Yeah. And for example, if you got high income, why not just put your money somewhere whereby it beats the saving rates that's out there? There's about 0.05 on average. Yes. Alternatively, you can try robo investment or stash away. But if you are someone that is very unsure or just begin, I would not advise that, because what you're doing is you're relying on AI plus fund managers. And when fund managers is involved, it tends to get a bit complicated because they are humans. Humans have feelings. So they are being pressured by investors as to generate higher returns. So when you're hiring returns, when down market, not many people can think rationally. And because you never know when it's going to go up, and you're afraid that it will go even lower lah. So that's the reason why I'll avoid robo and stash away at this point of time. Yes. Higher question lah. But I wear cap cause my hair very messy. In your opinion, how general REITs are doing now? REITs itself, they are not doing extremely well. Okay, US itself, 60% has deferred their rent payment or decided not to pay. They say, I pay another time, fuck it. Government is going to pay. Government is going to lend me money. I will consider it another time. Singapore itself, most of retails are actually deferring their payments to a later date. I can't even tell you how much or what the number are, because quarterly report is not out yet. But what I can tell based on the news and everything is that it won't be doing well in the short term. I mean, in the long term. REITs, you won't see a drastic change at this point of time because REITs take slower. Reason being is, for investor, you can see the stock market every single day, but for REITs itself, you only can see it monthly basis because you only pay up your rental every month kind of sense. yeah, maybe if let's say the first quarter result will come out, then I can start something on that. Then we can talk about REITs. But at this point of time, it's gonna be very volatile. I won't advise you getting into it unless you really know what you are doing or you really understand that company very, very well. Yeah. So what I recommend, yeah, $600 put into the OCBC, the Blue Chip Investment Trust. You just type OCBC Blue Chip Investment Trust, then you just read out on this. Not that I know of. No, not that I know of. Yeah. If have, I let you all know. But those people that are out there, okay, I'm not what's it called? I'm not marketing for OCBC. I just feel like if you got $600, you can put into here. Cause I mean, where else you want to put? I don't know where you want to put. Bank? Yeah. Yeah, if you lazy invest, you can just put your $600 here lah. Or do your homework, you can put here. What stocks and index are you monitoring now? I'm monitoring the healthcare industry, the finance sector. Some REITs, even though I tell you not to, but of course I understand I like the company very well. And some US market, some US stock. No, not really. OCBC don't sponsor me. I wish they do. If they, whoever is working OCBC now, you can consider me, you know. Yeah. Okay, so any more questions? Which companies to be exact for those industry? Wait, let me think. Okay, Capital DC is one of them. Capital DC is one of them. The one that I shared with you during the first session. Why I say that is because they are. How should I put this? Okay, they are REITs company. That's the thing. That's why I contemplate whether I should share or not. Because they are REITs company, so it contradicts what I say. But you need to understand where the company is coming from. So I think you can choose them. They are basically real estate investment trusts that take care of data centers in few countries. I think in 5 different countries: Australia, Malaysia, Singapore, the States, and the Europe region. Yeah. My position in this period. So what I'm doing is I'm actually doing you know, like just now I mentioned to you all, there's 3 kind of method: dollar cost averaging and value averaging. What I'm doing is I'm value averaging in cost and understand the underlying business model of the company. So I'm trying to go into it a bit by a bit lah, which is yeah. Does that answer the question? I'm not sure if I do. Let me find the slides. Okay. So earlier just now I mentioned there's like 3 types, right? So what I'm doing is, you know, sizing to my entry position into this period is I'm doing value averaging. So I'm not doing on a monthly basis whereby I fix, like I set a fixed sum, then I put in averaging every month. So what I'm doing is I understand the business. I put in basing on, I won't say I won't time the market, but I say in a time whereby where it meets certain criteria that I will cover next week. So to understand a company, there is few criteria that you have to look into before you decide that is a buy. So these are the ratios that I'm looking into, the numbers that I'm looking into before I decided that it's a buy. So what I'm doing is like very averaging in. So far, so any question? I left 1 minute. Are you investing capital gain or just dividend gain? I'm actually looking at both. So capital gain itself, that I'm looking more into the US market. Dividend gain, I'll look in Singapore. Cause US, most of major US company, they don't touch on, they don't issue dividend. They mainly focus on growth. OCBC, DBS, and what's the other one? Sheng Siong and Genting. These four. Less than 1 minute. I think still got time limit though. I'm not sure. I think you pay after that or something. I don't know how Zoom works. I haven't go and research. Oh, you want to can invest into Zoom.